The goal for this episode is to guide sellers on how to optimize operations pre sale to maximize valuation. Now, buyers are looking at your operations just as closely as they are your financials, or hopefully they are. Now, a strong balance sheet might get you in the room, but operational inefficiencies can cost you millions at the negotiating table. And it's really not the place you want to be. In this episode, I will break down how buyers assess operational risk, what you can do to streamline your process, and how businesses have increased their sale price just by improving operations. Even if you're on the fence about exiting, this is still something you should pay close attention to. And here's what I want to cover today. All right, we're going to cover how buyers assess operational risks, streamlining processes to increase valuation, reducing operational dependencies, financial and operational transparency, and technology and process documentation. Okay, first let's talk about how buyers assess operational risk. While financials are critical, we know that operational risk can make or break a deal. Key areas buyers tend to scrutinize are, and we've talked about some of these on other videos, are process maturity. Are operations standardized or are they reliant on these key individuals that we talk about quite a bit? Scalability. Can the business grow without massive investments? Things like technology infrastructure. Is the business running on modern systems or outdated legacy technology? And of course, regulatory compliance. Are there legal risks that could come back to haunt you as the buyer? Now, I want to give you an example. Imagine a company where a CEO personally approves every single major decision. If that CEO exits post sale, operations could grind to a halt. Buyers will see this as a major red flag. Next, I want to talk about process optimization, as I do quite a bit. A business with well defined, repeatable processes is far more valuable than one that relies on informal kind of know how. And I want to give you a few ways to improve operational efficiency before the sale. So, the first thing here, I want you to look at standardizing your workflows. Create clear SOPs, which is short for standard operating procedures. They don't have to be winded. I say that a lot. They just have to be correct and accurate. So, make sure you have those process maps all documented before you actually start writing your SOPs. You want to capture the process accurately. The next thing here is automate repetitive tasks, meaning reduce manual work where possible. And I know that this sounds really obvious, but I guarantee you there is room for improvement in your current organization right now. Okay. Next here is improve supply chain management. Minimize dependencies on those single vendors. Diversify your vendors by geographic region. And I really do want you to consolidate where possible, meaning tier 3 suppliers and maybe choosing better tier 2 suppliers and tier 1 suppliers that can offer you more goods or more than just, let's say, a few goods that they offered you when you signed that contract. I hope that makes sense. And lastly, here, I want you to strengthen your customer service process. Hear me out. You want to ensure that you have a seamless experience. Most of you may be under the impression that you already have a seamless experience, but it is a good idea to check so you can do things like secret shop your own business. And I know that this one is easier said than done, but I have confidence in you. There are a number of ways to go about this. The first is to start involving your team, ask questions, and revise where you can. Now, I want to move on to how to reduce operational dependencies. A major concern for buyers is operational dependencies, where the business relies way too much on certain employees, vendors, or customers. This is a red flag if you aren't thinking about exiting, or even if you are a ways off from exiting. This is a good idea to get your house in order, and these operational dependencies are critical to address. Let's dive into them. Okay. So, the first thing here I want you to look at doing is cross training employees. You want to make sure that no single person, and that includes you, by the way, holds all of the knowledge to anything in the operating of this business. Okay. The next here is I want you to diversify your customer base. If one customer accounts for 50% of your revenue, it is an enormous risk in general. The next thing I want you to look at correcting is develop vendor alternatives. Avoid reliance on a single supplier. We have talked about this countless times, but I can't stress it enough how important it is. If you've learned anything from COVID, is that 100-year events are becoming more frequent. And so think about this as not an if, but a when. Okay. And lastly, here, create a strong middle management. Buyers want to see leadership beyond the CEO. Okay. The next thing buyers will look at is operational transparency to ensure that there are no hidden risks. They are typically looking for things like hidden liabilities, undisclosed debts, legal risks, or compliance issues. Employee contracts and benefits. Unclear obligations can lead to post sale disputes. Make sure contracts and benefits are clearly written down, signed, accessible, and everything should be in one place. Revenue recognition and cost structures. Buyers want accurate financial forecasting, so you're going to need to produce how you came up with those numbers that you're presenting to them, okay? Customer churn and retention data. So buyers will be looking beyond the revenue numbers. So you want to make sure you understand your numbers and make adjustments where needed. Poor customer retention is not only stressful, but it also is kind of off putting for buyers. And it's not the cost of doing business. Get to the root cause of what's going on and fix it. They'll want to see these reports automated and not cobbled. So you will need to be able to back up what you're stating with data and facts for your buyers. They will not take your word for it. We've seen we've seen in the news M&A fails. I've even referenced some of them here. So be sure to address what you can address, even if it's only for your own valuation. You'll be able to gauge how you're actually doing and not guessing or doctoring numbers. And lastly, let's talk about technology and documentation. It's hopefully no surprise that I'm about to say what I'm about to say, but outdated systems or undocumented processes create uncertainty for buyers, making the deal very risky. It also makes work more complicated than it needs to be for your team and anyone who is being onboarded and for whomever is left when someone leaves the company. Now, it's worth investing the time now in doing this work before this becomes an unnecessary problem. Now, let's get a little bit deeper into this one. So, the first here is technology and documentation strategies before the sale. Okay. Couple of points here. Upgrade your core systems, meaning I want you to modernize your systems like your ERP, your CRM, accounting software, things like that to improve your valuation. Next, document these key processes. Buyers want clear, up to date, accurate operational guidelines, such as standard operating procedures, process maps, training collateral, or training software, even. Next, here you want to ensure your data integrity. Clean, structured data improves decision making in general. So, no cobbling that information together. And cybersecurity measures prevent risks related to data breaches. That means updated technology and appropriate security measures in place and vetting your vendors' security measures, which I think I probably don't talk about enough. So, I want to close this video out with a case study. You may actually be familiar with this one, although it is from 1998. So, admittedly, it is a while ago. But the case is notable enough to drive the importance of what we've been discussing today. No pun intended, or pun intended, actually. Now, some of you may remember the German auto giant called Daimler Benz and American automaker Chrysler Corporation. They announced a $37 billion merger. Now, remember, this is 1998. So this is a pretty large deal. Even now, that's actually a pretty significant number. But back then, it was pretty substantial. So they were aiming to create a global automotive powerhouse. I remember it as clear as day. The merger was presented as merger of equals, expecting to combine Daimler's luxury vehicle expertise with Chrysler's mass market strength at the time. Now, they were producing Chrysler was producing really attractive cars that were on the higher side but affordable. If you compared models like In the price range at the time, you could get a convertible for, I think it was called Chrysler Sebring for about 25 grand. So on the higher end, remember this is 1998, so on the higher end, but still relatively affordable considering. Okay. Next here is the operational misalignments that led to the failure. We'll start with cultural differences. Now, there were differences in management style. Daimler-Benz had a more formal, hierarchical management approach, whereas Chrysler sort of favored a more relaxed, team-oriented culture. This clash led to and hindered collaboration. The next issue, their decision-making process. Now, the differing approaches to decision making resulted in slowed operations and frustration among employees. The product positioning and the branding was another issue. The two companies had distinct brand identities targeting totally different market segments. Integrating these two brands without a clear strategy led to the confusion among consumers, I remember it, which diluted the brand value. Operational integration challenges, and you may not have thought this because they're both car manufacturing companies, but this was an enormous problem. Integrating manufacturing processes, supply chains, and things like product development strategies proved to be more complex than initially anticipated. So the lack of synergy realization led to the increased operational costs. The outcome for this merger was it was an epic fail. This transaction failed to deliver the expected synergies and financial performance. In 2007, less than a decade after this merger, Daimler-Benz sold Chrysler to a company called Cerberus Capital Management for $7.4 billion, which was a fraction of the original merger value. If you remember, I said it was $37 billion. What are some of the lessons that we learned here in hindsight, right? Cultural compatibility. Ensure cultural alignment is a critical factor in mergers to facilitate smooth integration and employee satisfaction. The next thing here I really want you to look at is having a clear integration strategy, developing a detailed plan for integrating operations, branding, and management. And the last thing really I think we've learned here is have realistic synergy expectations. Setting achievable goals for synergy realization helps in measuring success and maintaining stakeholder confidence. Okay, I have one more case study that I want to go over, and I think it may drive home what I'm saying here, which is yes, it can happen to you. Operational blind spots have happened to these corporations. Arguably, they also have very smart, capable professionals on both sides of the table. Do your due diligence and be thorough about it. All right, let's dive into this next one. This is a US merger fail. In 2015, hear me out, Dollar Tree acquired a company called Family Dollar for $8.5 billion. They were hoping to expand their reach and compete with rivals like Walmart or Dollar General. But instead of growth, the deal became a cautionary tale in operational blind spots. Some of the problems we'll mention here, there were two different business models. Dollar Tree has a fixed price model, fairly lean operations actually, and a relatively efficient supply chain. The company Family Dollar actually has variable pricing, they have struggling stores, and a complex inventory process and needs. Now, I'll just give you some context for those who may not be familiar with either of those stores. But, and this is, by the way, according to the CEO of both companies, Dollar Tree mostly caters to middle income consumers in suburban areas, while Family Dollar tends to cater to lower income or underserved areas. So, again, they appear to be very similar, but operationally, they were very different. So here's what happened. The integration failed from supply chain disruptions to store neglect and pricing conflicts, all of which drove customers away instead of bringing them in. The consequence here was an $8.5 billion mistake. Despite efforts to revive Family Dollar, operational misalignments led to declining sales, store closures, and frustrated customers. In 2024, Dollar Tree finally decided to sell Family Dollar, effectively undergoing the acquisition and taking a pretty significant hit, selling to a group of investors for $1 billion. So, what's the lesson? Do your operational due diligence. It is critical. Financial strategy alone doesn't guarantee M&A success. If operations don't align, the deal is doomed. Dollar Tree's failure proved that overlooking integration challenges can turn a $1 billion expansion into a multi-billion-dollar loss. So let's recap here really quick. If you're preparing your business for a sale, focus on these things: streamlining your operations, reducing dependencies, improve your transparency, of course, upgrade your technology where you can. And lastly, I really want you to document those processes. I know I say it a lot. I can't even stress how important that is. A well prepared business not only sells faster, but commands a higher price. So if you want to go deeper, check out our next episode where we discuss operational due diligence from the buyer's perspective. I'll see you next time.